Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you. On Australia's Business Channel. Welcome to Your Money, Your Call.
Hello and welcome to Your Money, Your Call. I'm Diana Dorothy. For an increasing number of Australians, superannuation, retirement and wealth creation are pressing issues. So on tonight's program, we look at how to plan for your twilight years. Joining us is Dante DeGori from Clearview Retirement Solutions and Sam Henderson, Managing Director of Henderson Maxwell. Both organisations specialise in retirement and investment. So if you've got any questions about preparing or planning for your retirement, please give us a call, 1300 30 34 35, or you can email us at yourcall@skynews.com.au. Gentlemen, welcome to the program.
Thank you.
I guess it's on everybody's lips, irrespective of how old you are, but particularly for, say, the baby boomers, just how much money do they need, how much money have they got, and will they be able to retire comfortably? We've heard a lot about do-it-yourself super. Let's kick off and talk about, Sam, if you want to lead us in discussion about do-it-yourself super and how it works and the benefits of.
Sure. We've seen an absolute proliferation of DIY super in the last few years, and we've probably got about 360,000 DIY super funds around Australia at the moment. There's about 3,500 new funds being formed each month. So it's probably the boom industry right now. There's a lot of talk about DIY super. That being said, there's about 10% of those fund owners that are actually getting out of DIY super because it's not appropriate for them. So I think it's very important to make sure that if you are considering a DIY super fund, that you know what to expect and you know why you're actually setting it up. You're not setting it up because your accountant tells you to. You're setting it up because you want more control, you want more flexibility, maybe some more choice in the products that you've got within your super funds. So particularly people wanting property in super or assets that aren't readily available in an industry super fund or in a standard retail super fund.
But I suppose, too, Dante, I'll bring you in. We've got an email that's come through. It's probably now's as good a time as any to have a look at it. It's from Wayne, and he writes, "My wife and I have our own place of residence, an investment unit and shares worth around $140,000. My wife has super worth around $40,000 and I've got super worth about 10. I've just earned 50 this month and I was wondering if it would be prudent to sell some of our shares and put that money into superannuation. Could you please advise?"
Yeah, interesting point. There's a number of issues when setting up a self-managed super fund, and I think one of the most important ones is that making sure you've got enough money to be able to justify it. The fact is the ATO set a benchmark around the 200,000 mark, and they feel that is probably an amount that's sensible enough based on the fees and charges associated with administering the fund that would be sensible in setting up.
Just looking at the clients that you have, what is the biggest concern? Is it, I'm not going to have enough money?
Absolutely. How much do I need is probably the single most asked question is, how much money do I need in retirement? Yeah.
And you tell them what?
It depends.
It depends. Same answer, there you go. So no, it totally depends on their lifestyle, but it really depends on their budget and how much they spend. So if a client comes in and says, we need $50,000 a year to get by, then we actually work it backwards from there. So you could effectively multiply out or multiply backwards how much you need by, say, somewhere between 15 and 20, and that would give you your lump sum. Yeah. So if you need $50,000 a year, you're going to need somewhere around about 600, 700,000 up to $1 million.
Yeah, and what the figures tell us is that people are retiring at the moment with an average of $202,000. That figure of between $600,000 and $1 million gives you a quote-unquote comfortable lifestyle. What does $202,000 buy you in 25 plus years of retirement?
Not a huge amount. If you retire at age 65, yeah, I mean, you literally are. If you retire at age 65 with 202,000, you're effectively drawing down a minimum allocated pension, which would give you about $10,000 a year. Then you get the age pension. You'd get the full age pension if you're a home owning couple on that, and that would give you another maybe $23,500 a year. So you're looking at around about a $35,000 a year retirement. But you also get the low income pension card. You get cheaper utilities. You get the pharmaceutical benefits. So there, it's still a reasonable retirement. I don't think it's a skimpy retirement, but you know, you're certainly not going overseas
European
every
holidays,
year.
yeah, exactly.
Exactly.
But I think that's the key, though.
So I'd say your benchmark's probably around the 200,000 mark. So it would certainly make sense for Wayne to be considering it based on his age. He's still got some growth in his assets, although his assets are reasonably low in terms of super at this point in time.
So you're saying 200,000 to have in your super fund?
Correct. Yeah. To set up a self-managed super fund.
Right.
Yeah,
Okay.
that's about the figure that the ATO set. But you know, there's no real benchmark. There's no legislation that says you must have at least 200,000. But that's a benchmark that they set, given the fact that it might cost you $1,500 to $2,000 a year to actually administer that fund.
All right, so he's got shares around $140,000 worth and an investment unit. Would it be worth perhaps selling some or all and putting that into a self-managed super fund of $200,000?
Certainly worth having a look at. Obviously, if you're disposing of an asset or even looking at transferring an asset from your own name into a super fund, you've got some issues. The first thing is you can't transfer a residential property from a super fund from an individual name into a self-managed super fund. So in fact, with a residential property, you'd have to sell that, which stimulates capital gains tax. He can reduce that capital gains tax by making either salary sacrifice contributions to super, or if he's self-employed, making a deductible contribution to super, and then putting the remaining funds into his self-managed super fund. So certainly worth having a look at for Wayne. It does obviously depend on his specific circumstances.
Have you got any advice, Dante, on that one as well?